2 weeks ago, in Austin, Texas, on a Friday evening at a company alumni event in a downtown rooftop bar, a 39-year-old software engineer named Marcus Hayes was holding a glass of red wine and chatting with someone he hadn't seen in 4 years. Her name was Patricia. She had been the chief financial officer of Marcus's company until she retired in 2022. She'd run the financial side of the business for 14 years before that, including the years Marcus had joined and grown into a senior engineering role. Marcus was telling Patricia about his recent promotion. He'd received a 3.2% raise that week, $4,096 a year, bringing his salary from $128,000 to about $132,000. He was pleased. The boss had told him it was above market. He'd accepted on the spot. Patricia listened, took a sip of her wine, then started laughing softly, in a way that wasn't mean, but also wasn't kind. She said, "Marcus, do you actually know what you generate for that company every year?" Patricia pulled a cocktail napkin from the bar, took a pen from her purse, and in 90 seconds, she wrote out the math. Revenue per software engineer at Marcus's company, $475,000 a year. That number had been published in their last earnings report. Marcus could verify it himself. Marcus's total loaded cost to the company, about $168,000. Salary of $128,000 plus approximately 30% for benefits, payroll taxes, equipment, and office overhead. The profit margin the company earns from Marcus's work, approximately $307,000 a year, after his loaded cost is subtracted from the revenue he generates. Across the 7 years Marcus has been at the company, that's approximately $2.1 million in profit he has personally generated. The 3.2% raise he just accepted, $4,096, is roughly 1.3% of the $307,000 profit Marcus produces every year for the company. Patricia handed him the napkin, said, "You're not getting a raise? They're giving you back 1.3% of what they earn off you. Don't confuse the two. I'm Trish, and I read the policies and the math nobody bothers to explain. So the actual math your employer runs to value your work, the 3 specific reasons most professionals are quietly underpaid by $30,000 to $70,000 a year compared to what they generate, and the negotiation framework that captures more of that value back. You're going to know by the end of this video. Here's what makes this dynamic so quiet. The math Patricia drew on that napkin isn't secret. It isn't hidden. It's literally published every year in every public company's annual report in a metric called revenue per employee. Anyone can look it up. Almost no working professional ever does. For S&P 500 companies, the average revenue per employee runs around $500,000 to $600,000 a year. For high-margin software companies, it can exceed $1 million per employee. For mid-tier service businesses, it runs $250,000 to $400,000. The math from there is straightforward. Take revenue per employee. Subtract the employee's loaded cost, typically 1.3 to 1.4 times their base salary plus a share of overhead. The remainder is the profit margin the company earns from that employee's work. For most working professionals earning between $80,000 and $200,000 a year, the profit margin their company earns from them is somewhere between $50,000 and $300,000 a year. Higher in software, finance, consulting, lower in retail, hospitality, manufacturing. This is not exploitation in any sinister sense. It's the basic math of how businesses work. The company combines your labor with capital, technology, brand, customer relationships, and infrastructure to generate output that's worth more than the sum of its parts. The profit margin is what compensates the company for providing those things. But here's the part that matters for you. The profit margin your employer earns from your work is the actual economic value you create. Your salary is the negotiated share of that value you take home. The two are not the same thing. They diverge dramatically across different employers, different roles, and different negotiation stances. Marcus's company earns $307,000 in profit from his work each year. Marcus takes home $128,000 in salary. The split is roughly 30% to Marcus, 70% to the company. That split is not fixed by physics. It's negotiated, and most professionals never run the math to know what they could be negotiating for. Today I'm walking you through Patricia's framework, the exact math of revenue per employee, why salary surveys quietly understate your real value, and the 3 specific negotiation moves that working professionals can use to capture more of what they're already creating. One thing before Patricia's framework. I'm not telling you to demand 70% of the profit margin you generate. That's not how labor markets work. The company shoulders the risk, provides the infrastructure, and pays you regardless of whether the business has a good or bad year. Some share of the profit margin going to the company is completely legitimate. What I am telling you, most working professionals are getting an unnecessarily small share of the value they create. Not because they're bad at their jobs, because they don't know the math, don't run the calculation, and accept whatever the company offers without reference to the actual profit margin being earned from their work. The companies that pay best and the bosses who give the largest raises usually don't volunteer this math. The professionals who get the largest raises and best terms are usually the ones who understand the math themselves and bring it into the conversation. That's the asymmetry. Your employer knows their revenue per employee. Your HR department knows their compensation budgets relative to that revenue. Your boss knows what the next tier compensation band looks like for your role. None of these people will share that information with you unless you specifically ask the right questions in the right way. Today's video is about how to ask, and what the math tells you to ask for. The 4-part calculation, what you're actually generating. Step 1, find your company's revenue per employee. For public companies, this is published every quarter in earnings reports. Total annual revenue divided by total employee count. For private companies, you can usually find an estimate on Comparably, Glassdoor, or industry reports. Reasonable approximations work. Exact precision isn't necessary. For software companies, typical revenue per employee runs $400,000 to $1,200,000. For financial services, typical revenue per employee runs $300,000 to $800,000. For consulting and professional services, typical revenue per employee runs $200,000 to $500,000. For retail, hospitality, basic manufacturing, typical revenue per employee runs $150,000 to $300,000. Step 2. Calculate your loaded cost. Take your base salary. Multiply by 1.3 to 1.4 to account for benefits, payroll taxes, and basic overhead. Add another $5,000 to $15,000 for shared corporate overhead, office space, IT systems, support staff, software licenses, depending on company size. Base salary, $128,000. Multiply by 1.3 equals $166,400, plus approximately $2,000 for his share of corporate overhead. Total loaded cost, approximately $168,000. Step 3. Calculate the profit margin you generate. Subtract loaded costs from revenue per employee. The remainder is the gross profit margin the company earns from your work. This isn't net profit at the company level, which factors in things like research investment, debt service, and corporate taxes. It's the gross profit margin, the part that's specifically attributable to your work after your direct costs. Step 4. Calculate your share. Divide your salary by the total profit margin you generate. The result is the percentage of the value you create that you actually take home. $128,000 divided by $128,000 plus $307,000. Total value created is $435,000, equals approximately 29%, taking home 29% of the economic value he creates. The company is keeping 71%. Personally created approximately $3 million of total economic value for his company. He has received approximately $880,000 in salary across that period, a meaningful career income, but a small share of the $3 million he generated. This is the math. Once you can run it for yourself, every salary discussion becomes different. You're no longer asking for a raise. You're negotiating the share of value you create that goes to you versus the company. Why most professionals are underpaid. The 3 structural reasons. Patricia explained why this gap exists for most working professionals. 3 specific reasons account for almost all of it. Reason 1. Salary surveys understate true market value. Glassdoor, Salary.com, Indeed, and similar tools report average salaries paid for specific roles. They do not report what those roles generate for their employers. The number you compare yourself to is what other people in your role get paid, not what your role is actually worth. This anchors negotiations to what's been paid historically. Companies use it to justify offers in the standard range. Employees use it to validate that they're fair. Both miss the underlying value question entirely. The right comparison isn't, what's the median salary for software engineers in Austin? It's, what's the revenue per employee at companies hiring software engineers in Austin, and what share of that should go to my compensation? Reason 2. Annual raises lag inflation and lag productivity growth. The standard 3 to 5% annual raise looks reasonable until you compare it against actual productivity growth and revenue per employee growth at most companies. If your company's revenue per employee grew 8% last year and you got a 3% raise, the company captured 5 percentage points of additional margin from your work that you didn't share in. Across 7 to 10 years, this gap compounds dramatically. Marcus's salary grew 22% across his 7 years at the company. The company's revenue per employee grew approximately 47% across the same period. This pattern is almost universal at companies that aren't aggressively bidding for talent. The slow walk raise pattern is the default. Most professionals accept it because they don't run the underlying math. Reason 3. Internal promotion paths consistently underprice external market value. The biggest single mistake most professionals make is staying at the same company across multiple promotion cycles. Internal raises are calibrated to what HR considers reasonable progression for an existing employee. External offers are calibrated to current market value at the new company. For most professional roles, switching employers every 3 to 5 years produces 25 to 40% total compensation increases versus the 8 to 15% you'd get from staying through internal promotions across the same period. The 3 negotiation moves. Move 1. Calculate your value formally and document it. Before any salary conversation, run the 4-step calculation. Write it down. Have specific numbers, not approximations. Then add specific accomplishments. Projects you led, revenue you contributed to, costs you saved, problems you solved. Tie each accomplishment to a dollar value where possible. Documentation will include his role's revenue per employee benchmark, $475,000, his loaded cost, $168,000, his current profit margin contribution, $307,000, and the specific projects across his 7 years that account for measurable revenue contribution above the team baseline. The documentation isn't to share with HR initially. It's to know your own number before you walk into the conversation. Most professionals don't know their own number. Move 2. Get a competitive external offer before any internal negotiation. The single most effective negotiation move is bringing a real competing offer to your current employer. This requires actually interviewing externally. Most professionals find this uncomfortable. The time investment, the imposter syndrome, the loyalty pressure. The professionals who do it consistently are the ones who maximize lifetime earnings. The conversation isn't, "I'm leaving unless you match." The conversation is, "I've been approached and have an offer at X dollars. I'd like to stay if we can align on a similar number. Can we discuss?" This works because the company's cost to lose you and replace you is dramatically higher than the cost of giving you a meaningful raise. Replacement costs typically run 100 to 200% of annual salary across recruiting, training, lost productivity, and risk. A 15 to 20% raise is cheaper than replacement. Move 3. Request a structural compensation review, not just a number. The third move applies for professionals who want to stay at their current company long-term but want to fix the cumulative compensation gap. The conversation goes, "I'd like to schedule a comprehensive compensation review covering the past 3 years of my contributions, my current market value based on external benchmarks, and the appropriate compensation level going forward. Can we set up a 90-minute meeting next month?" This frames the discussion as a structural review rather than a one-time raise request. It signals that you've done your homework and that you expect a serious conversation rather than a routine annual adjustment. The outcome of this conversation is rarely a 25% raise on the spot, but it often produces a multi-year plan with specific milestones, equity grants, title progressions, and structured raises. Across 2 to 3 years, the cumulative impact can be 30 to 50% of base compensation increase. 3 objections come up here. Let me handle them. Objection 1. I don't want to seem greedy or aggressive. My employer has been good to me. Reasonable concern. Wrong framing. Asking for compensation that reflects the value you create isn't greedy. It's the basic transaction your employer is also engaged in. They're paying you what they need to pay to keep you, calibrated to their internal budget constraints and the labor market. They're not being greedy. They're being economic. You should be too. The professionals who under-negotiate often do so out of misplaced loyalty or fear of seeming difficult. The companies that benefit from this pattern do not similarly undercharge for their products out of loyalty to their customers. The asymmetry is one-directional. They negotiate hard, you negotiate softly, the gap accumulates across years. You can be respectful, professional, and even warm in compensation conversations while still advocating firmly for your value. The two don't conflict. The companies that respond to firm advocacy by becoming hostile are companies you should leave anyway. The companies that respond constructively are the ones you want to stay at. Objection 2. I'm not in a high-margin role. The math doesn't work for me. Sometimes true, often false. Even for lower margin roles, the calculation reveals something about the value you create. A retail employee generating $200,000 of revenue per year with a loaded cost of $50,000 generates $150,000 of profit margin. They're typically paid $35,000 to $45,000. Their share of value created is around 20 to 25%. The negotiation tools that work for higher margin roles also work in modified form for lower margin ones. Document your specific contributions. Get external offers. Request structural reviews. The percentage gains might be smaller in absolute dollars, but the share of value captured can still meaningfully improve. The other option for lower margin roles is to migrate to higher margin sectors. The same skill set in a higher margin industry creates different math. A salesperson in retail and a salesperson in enterprise software may have similar skill profiles, but the revenue per employee math differs dramatically. Career mobility into higher margin sectors is one of the largest lifetime earnings drivers most professionals don't fully exploit. Objection 3. What if I run this calculation, ask for more, and get fired? Almost never happens. The narrative that asking for raises gets people fired is largely manufactured to keep employees from asking. Companies fire people for performance issues, organizational changes, and budget cuts. They very rarely fire people for asking for raises through proper channels. If you're a productive employee who asks professionally for compensation aligned with your value, the response is typically negotiation, not termination. The professionals who do get terminated after raise requests are usually ones who either ask in unprofessional ways, ultimatums, anger, or have underlying performance issues that the raise request brought to attention. If you're a solid contributor asking professionally, the worst-case outcome is, "We can't do that right now," not termination. The fear of termination keeps far more compensation locked up than termination itself ever does. The wealthy professionals I know all share one trait. They ask regularly and professionally throughout their careers. The compensation gap between them and their peers compounds dramatically over decades. Action steps. 3 steps. This week, none of them require quitting your job or taking immediate risks. Step 1. Tonight, the 4-step calculation. Run the 4-step calculation for your current role. Find revenue per employee at your company. Annual report, comparably industry estimates. Calculate your loaded cost. Base salary times 1.3. Subtract loaded cost from revenue per employee. That's your annual profit margin contribution. Divide your salary by total value created, salary plus profit margin. That's your current value capture percentage. Write down the 4 numbers. They are the foundation of every future compensation conversation you'll have. 20 minutes tonight. Step 2. This week, the market benchmark research. Pull external market data for your role at companies in your size range and industry. Use levels.fyi for tech roles, Glassdoor and salary.com for general professional roles, industry-specific benchmarks where available. Find the 50th, 75th, and 90th percentile compensation for your role at companies similar to yours. Write down the numbers. Compare your current compensation to those percentiles. If you're below the 75th percentile, you have a compelling internal case. If you're below the 50th percentile, you should be actively interviewing externally. 30 to 45 minutes this week. Step 3. This month, the framework choice. Based on the calculations from steps 1 and 2, choose your path. Path A. Your current company is fundamentally fair. You want to stay. You're below market by 5 to 15%. Schedule a structural compensation review meeting with your manager. Bring your math. Path B. You're 15+% below market, and you're willing to consider switching companies. Start interviewing externally. Get offers. Use them to negotiate up at your current company or to move. Path C. You're 15+% below market, and you've been at the company for 5+ years, and raises have been small. The most likely path forward is switching employers. Start the search process this month. The 25 to 40% jump that comes with switching is hard to replicate through internal advocacy alone. If this video helped you, or if you've ever accepted a 3% annual raise without running the underlying math, do me one favor. Hit the subscribe button. New video on this channel every single day. Each one is a specific move that puts real money back in your pocket. Same way this one just did. And here's what's coming tomorrow that completes this entire series of 30 videos. There is a specific dollar amount, $10,000, that when held in liquid savings fundamentally changes the texture of your financial life. Not your retirement balance, not your home equity, just $10,000 of accessible cash. Below that threshold, everyday financial decisions get made under stress. Above it, decisions get made with breathing room. The transition between the two is more important than people realize, and the path to crossing it from below is well documented across decades of behavioral finance research. Tomorrow, I walk you through exactly why $10,000 is the threshold, the 5 specific things that change about your daily life once you have it, and the no-buy framework that's helped working professionals across the country quietly cross the line in 9 to 18 months without dramatic lifestyle compromises. If you've never felt like you've crossed that line, or if you've been there and slipped back, tomorrow's video is the one you've been waiting for. I'm Trish. Talk to you then.